Let's talk about one of the most famous and maybe infamous numbers in all of finance, 2 and 20. For years, it's been the secret handshake of elite investment funds. But is it really a fair price to pay for financial genius? Or is it just an old habit the industry can't shake? Well, we're going to dig in.
You can make a pretty strong case that this is the most argued over number in the entire financial world. For decades, it was the absolute standard for hedge funds, for private equity. But now, it's facing some serious heat. So what is this rule that has everybody talking?
Okay, so what does 2 and 20 actually mean? It's pretty simple, really. It's a fee with two parts. The 2 is a 2% management fee. They charge this every year on all the money they manage for you, no matter what. You can think of it as what keeps the lights on and pays all the analysts. But the 20, that's the exciting part. That's a 20% performance fee. It means the managers get to keep a fifth, a full 20% of any profits they make for their investors. Sounds simple enough, right? But the debate around these two little numbers is where it gets really good.
To really get why this is such a big deal, we have to go back to the beginning. Why on earth did 2 and 20 become the gold standard in the first place? Let's look at the case for it.
So the people who defend this structure have a few key arguments. First, they say that 20% performance fee is everything. It means the manager only gets a big payday if you, the investor, get a big payday. Their interests are aligned. Then there's the 2% management fee. They'll tell you that's not just profit, it covers the massive costs of running a fund. You've got salaries, cutting-edge research, lawyers. It all adds up. And finally, and this is their knockout punch, that potential for a massive reward is what pulls the smartest people, the absolute top talent, into the industry.
So it all really boils down to this one idea. This fee structure is basically the price you pay for genius. The argument is that if you don't offer these incredible rewards, the best and brightest minds will just go do something else, and the amazing investment returns you're hoping for, they'll probably vanish right along with them.
Okay, but that is only one side of the story. Lately, the 2 and 20 model has come under some serious fire, and the arguments against it, well, they're pretty powerful. So let's flip the coin and look at why this whole model is starting to show some serious cracks.
The complaints against 2 and 20 really come down to two huge problems. First, and this is the big one, underperformance. For years now, a ton of these super expensive funds haven't even managed to beat simple, cheap market index funds. So investors are starting to ask, wait a minute, why am I paying you a fortune for results I could get for almost nothing? The second point is maybe even more troubling. It's all about misaligned risk.
And you can see why this is where the argument really heats up for investors. They're looking at their statements, they see these high-fee hedge funds struggling, and then they see a simple, low-cost index fund doing just as well or sometimes even better. That question becomes impossible to ignore. Why pay for the fancy meal when the cheap burger tastes just as good? The whole justification for 2 and 20 starts to look pretty shaky.
And look, it's not just small-time investors who are saying this. We're talking about Warren Buffett, one of the most respected investors of all time. He's been hammering this point for years. He says that when a manager gets a huge slice of the profits but doesn't have to pay for any of the losses, well, what do you think happens? It encourages them to take massive, sometimes crazy risks with other people's money. It's a heads I win, tails you lose kind of situation.
Now, this isn't just some academic debate. All this criticism, all this pressure, it's having a real impact on the industry. So for this last part, let's look at how the market itself is forcing a change in what people now call the fee squeeze.
So what exactly is this fee squeeze? Well, think about it. The big players, the giant pension funds and endowments, they're starting to use their power. There's so much competition for their money now, they can just say, no, we're not paying 2 and 20 anymore. Give us a better deal. They're negotiating, and they're winning.
And you don't have to take my word for it. The data tells the whole story. That classic 2% management fee, on average, it's dropped all the way to about 1.35%. And the 20% performance fee, that's now closer to 16%. Now, this isn't just a tiny tweak. This is a massive shift, a clear signal that the old 2 and 20 standard is dying, or at least it's being forced to change.
So, we've seen the argument for it, the argument against it, and the hard numbers that show a clear trend downwards. It all leads us to this final, really important question. The world of high finance is changing, no doubt about it. But are its legendary fees changing fast enough to keep up? That's the real multi-billion-dollar question.